Despite being Columbus Day and lighter volume in the US markets because of it, we do still see some pretty big swings happening. The Nasdaq's up 1% at the time of recording this. You've got gold slightly lower, and it's a very green day for my portfolio. As many of you guys will know that I am pretty long stocks right now, with what I think is a pretty hospitable environment for corporate earnings to continue to grow. You've got inflation cooling, you've got the Fed cutting rates, and you've got, AI as a theme, which is continuing to fuel this market. Now, all of that stuff will change, but for now, the bull run is full force, and I do think that it is set to continue as we step into election phase. So stay tuned. So the Nasdaq's up about 1% here at the time of recording. You get the S&P 500 about 0.8, the Dow Jones up just modestly, and the Russell up a little bit here. You've also got the dollar index higher today, and gold, silver, copper, and oil actually seeing down days on what was a little lighter than expected economic numbers out of China. Now, what can we as traders expect for this week? As we see, again, the Nasdaq making a breakout through these highs. The S&P 500 is also hitting an all-time high, by the way. That is an all-time intraday trading high as we speak, and markets just seem to be on a bull parade, and they just keep going higher and higher. Now, I want to talk about this subject because it's really, really important that you don't get bearish for the sake of getting bearish. A lot of traders will see this and they'll say, well, look, stocks are at all-time highs. They just keep going higher and higher, but at some point they're going to crater. And that will be inevitably true. If you say that for long enough, you will be right. The problem is trying to time when that happens can be very tricky. As I opened up with this in this video, I am currently very positioned on the long side of the stock market. For example, my biggest position is QQQ, which is the NASDAQ. So I'm long NASDAQ. Another big position for me is the semiconductors ETF, SMH, which I've been long for a good chunk of the year here. SMH is breaking out to the upside. These are companies like NVIDIA, AMD, Qualcomm, the chip manufacturing companies in the United States. And I've stayed long for some simple high-level economic data points that I want to go over really quick. Case number one is GDP growth has been pretty positive. It's beat forecasts consistently for some time here, where many people thought that the US economy would roll over and be really critical by now. It's actually shown plenty of growth here. And when we take into consideration that inflation is coming down nice and steadily, this gives us a good environment. It gives us a relatively hospitable environment, specifically because with inflation cooling off, it gives the Fed the A-OK to cut rates, and cutting interest rates cuts the borrowing costs that businesses and consumers have to pay, helping to spur growth in the economy. We've also seen an uptick recently in jobs data, and although the labor market has cooled off a little bit, it doesn't seem like it is cratering by any means. Take a look at JOLTS job openings, which for a while there we were pointing out that it was trending down, and arguably still is, but we've at least sort of bottomed out, it seems, around the 8 million job openings in the United States range. And this is important because we want to see the economy continue to stay strong and inflation to come down. And it seems like right now, tactically, we are achieving that goal, which of course is good for stocks and arguably is why stocks are continuing to trend higher. I do think that the NASDAQ will probably see all-time highs before the end of year, and the S&P 500 is well above those all-time highs as we speak today. So long story short, don't find a reason to be bearish just because the chart is up. You need to make sure that fundamentally you know why you're getting bearish. Now, one thing that we could indicate, some red flags here, is if we get into the sentiment side of things. If we take a look at the AAII Investor Sentiment Survey for stock traders, what we can see is that there's a pretty hefty bullish bias. Sentiment is pretty swayed one way. We see a very small number of survey respondents saying that they feel bearish, a chunk of people feeling neutral, but a big chunk saying that they feel bullish. And we do know that when, historically speaking, when this level starts to get a bit extreme, stock market may see a bit of a pullback, maybe a 5% correction could happen. And so I think that that's more than reasonable that we see that happen and still maintain a bullish bias. So for me personally, I'm not looking to buy at these levels, but I am watching closely for pullbacks in which I will be a buyer. And quantifying this bullishness for stocks is easiest when I use a system to do so. If I take a look at the indices on the Edge Finder, you can see we've got very strong readings for the S&P 500, NASDAQ, you've got the DAX, the Dow Jones, the Nikkei. All of these are giving us us bullish readings when considering sentiment data, technical data, and economic data like GDP, PMI numbers, retail sales, CPI like we just discussed, labor data, and interest rates. So overall, I lean bullish until this story breaks. But I want to reiterate something very important. Whether you trade indices or not, this is relevant to all markets. Don't find a contrarian case just because you don't like that price has gone up so much. That is a very weak case and has been the bane of the existence of short sellers on gold and indices this year. If there's not a reason to get bearish, don't force it. Speaking of gold, yesterday in my Sunday video, I forgot to do gold and I apologize. I did share it inside of our Telegram channel. I shared an update there on my analysis. By the way, if you'd like to join for free, the Telegram channel will give you updates where you can see things that I'm looking at, watching in markets, etc. The link for that can be found in the description down below. So if we take a look at gold here, the path is pretty clear. Trajectory is to the upside. I will mention that I am less bullish on gold than I am on indices at this time, however, because some of that economic data coming in real strong is a little bit of a bearish thing for the gold market. Why? Because the dollar is seeing strength. And I do think that dollar strength is set to continue. So it makes me a little less interested in being long gold and a little bit more preferable towards being long indices in specific sectors that I think could do well in a soft landing environment, which I think we are headed for. So when we look at gold's price action, what you could look for is to see if you're bullish, to see if we can actually take out these highs. And then what was potentially expensive could then actually look like a potential bargain if we continue to trend higher. Now, if you're a bear, what are we looking for? Well, bears are probably looking for a structural break of this upward trend, but trying to call when that's going to happen has been a very tough trade to time this year. So I don't think that I will be doing that, even if I do get some bearish readings on the Edge Finder, which recently we did get a slightly bearish lean on the Edge Finder. You can see a -4 for the Edge Finder's scoring algorithm for gold specifically. So even though we're getting that, I will still wait for price action to actually agree with that, specifically on the daily chart. So I'm looking for something like this to start if I'm going to get bearish on gold. But currently, there's no reason to fight this uptrend until, we get more solid evidence that it is turning to the downside. By the way, I've been referencing the Edge Finder several times in this video. This is a tool that my team and I have built over the last few years to help traders source fundamental analysis and look more in depth at what's happening with the financial markets, not from just a price perspective, but from a real world, real forces perspective, the macroeconomic data points like GDP statistics, inflation data, and employment data, and so much more, all in one tool. So if you don't already have a copy of the Edge Finder and you would like to try it out, we do have a trial down below in the description. That is not a free trial, it is a paid trial. If you are serious about this tool and you are interested in getting access to it, the trial gets credited towards your final purchase. You can find more information by using the link in the description down below. And I also did mention on stream today 2 things that I wanted to share these clips. The first clip that's going to be coming up in just a second is breaking down the commitment of traders data, which I think we did a pretty in-depth breakdown today. And the second thing we're going to discuss here is the dollar index strength. Some people have been confused recently as to why the dollar index has been strengthening even though the Fed is planning to cut rates. And I broke that down as best I could on the live stream today. So check out these clips. So COT Report, what is it? The COT Report is, of course, a way to track what institutional money is buying or selling. It is a weekly filed report by the CFTC, and it reports what big holdings are looking like for institutional money flow. We've aggregated it out for our users who are Edge Finder users. You can see all of this data in our simple to use visualization tool. And I'm going to just go through this really quick. So in terms of the COT report, let's look into what institutional money is buying and or selling. Take a look at COT net positioning. We've got the Canadian dollar, Swiss franc, treasuries, dollar, Bitcoin, SPX. These are the more bearish end of the spectrum in terms of institutional holdings. And if we flip that around and we take a look at the more bullish side, you've got the South African rand, gold, silver, Dow Jones, and oil. These are some of your most bullish on a holdings basis. So what are we looking at here? We're looking at the overall contracts, long versus short, held by institutional money, tracked from the CFTC. Okay, so when we look at the net holdings, this is what we're met with. Now, that's one side of it, but there's more to the COT report than just looking at the net holdings. The reason I say that is because this data right here is really only useful to you if you're holding positions for months and months and months, because this data is slowly changing. Like these asset lists have stayed this way for months. They don't change that frequently, and they change very slowly. They climb up or down the ladder. Now that climbing component, that's where the COT report gets interesting. And we've built the change week to week table right here. This is the latest weekly COT filings, latest buys and sells from the Edgefinders COT report. Now, this is where you want to pay attention if you are a trader. Now, if you're an active trader, this is showing you the change in contracts from the last week to the current week reporting. This is why it's so useful. When you're looking at this, you say, okay, look, the Australian dollar got some big bullish action. They added lots of longs. They closed lots of shorts. They reduced short holdings. They increased long holdings. We get a nice bullish net change. Okay, US oil. Take a look at US oil, and what we've got here is change in short contracts. They dramatically reduced short holdings on oil price, and they increased. When I say they, I'm talking about the hedge funds, small banks, big banks reporting funds to the CFTC showed big buying for US oil. Okay, let's keep going. Treasuries also got a bid. We saw a big increase in longs and a massive decrease in shorts. So treasuries reduced shorts. That's pretty big. Take a look at the Swiss franc. They added some Swiss franc positioning, added some Dow Jones, pound, Bitcoin, copper, silver. Let's take a look at some of the things that they sold. They sold some gold, right? So gold got some bearish activity. Let's take that into consideration. They added a little bit of shorts, but they dramatically reduced long positions. That is pretty bearish, right? So if everybody's closing out longs, that is something to pay attention to. We are actively in this conversation, we are actually tracking institutional money. We're not guessing on what institutional money is doing through candlestick patterns, which I think is kind of silly. I think that this is the way better way to do it. You're actually looking at the CFTC's report of what institutional money did. Did they close positions? Did they buy positions? Did they initiate new positions? On gold as an aggregate, they reduced longs. They increased shorts. Okay, let's move on. SPX, NASDAQ, both of these saw a little bit of bearish activity. They added some shorts to SPX. They added a little bit of shorts to the NASDAQ. US dollar, Canadian dollar, platinum, Russell, yen, and Nikkei. These things mostly got sold on the CFTC's weekly reported numbers. When we look at the dollar index, how does the dollar, I know a couple of you guys mentioned that you're still a bit confused on the dollar strength. Here's an example of what might be confusing. Rate cuts in the United States. Most of us are on the same page. Okay, if rate cuts happen for the US, the dollar should go down, right? Wrong. That's not the only variable, because currencies, as you know, trade in currency pairs, right? The relative performance of one currency impacts the others. So let's break this down. Why is the dollar index going up even though the Fed is expected to continue cutting rates? Here is how that function works. Let's first talk about the DXY, the dollar index. How is it calculated? The dollar index is a instrument that looks at essentially all the other major currencies, like the euro, the pound, the Australian dollar, the yen. So the DXY is looking to in order to give up a price on currency. How do you put a price to a currency, right? That sounds kind of confusing. Well, it's all relative to the strength of the other currencies. So when you look at the dollar in isolation, you're really looking at the dollar in relation to the pound, the euro, the Australian dollar, etc. So the dollar index is trading higher even though the Fed is expected to cut rates. Well, here is why. It's because other currencies are also seeing rate cuts happen in their countries. We have this week, the ECB is expected to cut rates. The Bank of England is expected to cut rates at a point. The Bank of Canada has been cutting rates pretty aggressively. So let's go back to our drawing here. So remember how, yes, rate cuts are generally speaking bearish for a currency. Let's say that this yellow line is the Fed. This is the Fed and their projection of interest rates. Okay, we're looking at an interest rate graph over time. Just pretend that that's what we're doing. I'm gonna draw this out for us. So we have the Fed is expected to cut interest rates over time. So we know that the dollar index should go down, right? Well, not necessarily. The dollar index could actually go up during this Fed cut because it's about what other currencies are doing too. Remember, that's how the dollar index is calculated. So what if other central banks cut rates at a slower pace, right? If this is our other central banks, like the ECB, the Bank of England, the Bank of Canada, if those banks are cutting their currency's interest rate slower, then what does that do to the dollar? Makes the dollar look weak, right? Because then it's like, oh, the Fed is cutting rates. Get out of the dollar. Let's go to these other currencies, because those other currencies, if we buy bonds there, if we buy that currency, there's more money to be made holding on to those other currencies. So why would I want US dollars? But that's not the case that we find ourselves in right now. Okay, right now, a couple months ago, it looked like the US data was coming in real weak and that the Fed was going to cut faster than the other central banks. That's why the dollar index was trending lower. This is why fundamentals are so important, guys. If you understand this, you understand why currencies are moving. It's not just squiggly lines on charts anymore. It's actual real world stuff. So let's reverse this now. Let's say that we go back to this and we said, okay, what if this is the Fed? This is the projection for rate cuts from the US. But then what if the other currencies, which we'll mark in red, are expected to cut rates faster, right? So if this scenario happens, it's kind of like, okay, the other central banks are cutting rates faster. Maybe their economies are weaker. A weaker economy makes that currency less attractive. Cuts in that economy's central bank rate are bearish for the currency. So in that case, look at this dynamic, right? The US is cutting their rates, but they're cutting their rates at a slower pace than other central banks. In this case, you can have dollar strength even though rate cuts are coming for the Fed. Does that make sense? Do me a favor, if that helped, type yes in the chat. Just let me know by typing yes. I know this is a bit of a complex topic at first, but once you kind of get it, you're like, oh, so this is just like a race. The race to the faster rate cuts are going to be more weak. The slower rate cuts are going to be more strength for that currency. It was a little bit easier when in 2022, it was the opposite way. When everybody was the race for rate hikes were the opposite effect. Let's say that this was other central banks, right? If you're talking about rate hikes, but this was the Fed, right? Do you guys remember? Some of you guys might have been trading. Some of you guys might be more new than that. But if you were trading during 2022 and the Fed was hiking rates much faster than other central banks, the dollar was a beast that year. And it was just a wild year for the US dollar. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.